Before we begin, please remember that I am not a licensed financial advisor or insurance agent. This presentation is for informational and educational purposes only. The information provided is not intended as financial, legal, or insurance advice. Always consult with a qualified and licensed professional before making any decisions about your own insurance coverage. Your personal situation is unique, and the details of your policy may vary by state and provider. Imagine this for a second. You're driving home, listening to your favorite podcast, thinking about what's for dinner. Suddenly, bam, a car runs a red light and plows right into your side. It's a nasty crunch of metal. Airbags deploy. But after the initial shock, you take a deep breath. You're okay, a little shaken, but okay. And you think, thank God I have full coverage. You make the call to your insurance company, confident that they'll handle everything. And then the agent on the other end of the line says the 7 words that will turn your world upside down. I'm sorry, but that's not covered. How is that possible? You've been paying your premium every single month on time for something called full coverage. It's a promise, right? A guarantee. Wrong. And that single devastating misunderstanding is the reason millions of Americans are just one bad accident away from financial ruin. Here's the hard truth. The secret the insurance industry doesn't really want you to think about. Full coverage auto insurance doesn't actually exist. It's not a real product you can buy. It's a marketing slogan, piece of slang, a dangerously misleading myth that gives drivers a false sense of security. And in this video, we are going to tear that myth apart piece by piece. We are going to expose what full coverage really means, what it actually covers, and more importantly, what it leaves dangerously exposed. By the time you finish watching this, you won't just understand your auto insurance policy. You will master it. You will walk away with the knowledge to protect your car, your savings, your home, and your family from the financial catastrophe of a major accident. You'll be able to look at your policy, called a declarations page, and understand every single line. You'll be able to call your insurance agent and have a conversation as an equal, not as a confused customer. You will know exactly what questions to ask and what coverage you truly need, potentially saving you thousands of dollars not on your premium, but in the event of a claim, which is when it actually matters. So what are people talking about when they say full coverage? Usually, they're talking about a policy that bundles 3 core types of insurance. Think of them as the 3 legs of a stool: liability, collision, and comprehensive. If your stool is missing any of these legs, it's going to fall over. Liability is the first and most important leg. In the simplest terms, liability covers the other guy. If you cause an accident, it pays for the other person's medical bills and their car repairs. This isn't for you. It's for the people you might hurt or whose property you might damage. Every state in the US, except for a couple with weird rules, legally requires you to have this. It's the bare minimum to be on the road. The second leg is collision. This one is simple. Collision covers your car when you collide with something. It could be another car, a telephone pole, a guardrail, a fire hydrant, you name it. If you hit something and your car is damaged, this is the coverage that pays to fix it, or, if it's totaled, to replace it. The third leg is comprehensive. This is the everything else coverage. Think of it as protection from acts of God and criminals. A tree falls on your car during a storm? Comprehensive. Your car gets stolen? Comprehensive. A deer decides to play chicken with your front bumper on a country road? Comprehensive. Hail, fire, floods, vandalism, all of that falls under this third leg. So, liability for the other guy, collision, and comprehensive for your car. That sounds pretty complete, right? That sounds like full coverage. And that is precisely the trap. Because even if you have all 3 of these in robust amounts, there are massive gaping holes in your protection. Holes that can easily swallow $100,000 of your money after a serious accident. What about your medical bills if you're injured? What if the person who hits you has no insurance at all, or the absolute bare minimum? What if your car is in the shop for 3 weeks and you need a rental to get to work? What if you need a tow truck? None of that is automatically covered by those big 3. Those are all separate coverages you have to specifically add, and most people don't even know they exist, let alone if they have them. So, let's start building your bulletproof policy from the ground up, beginning with the single most important part of your insurance: liability. This is the one that protects you from being sued into oblivion. When you look at your policy, you'll see your liability coverage listed as 3 numbers, separated by slashes. It might look something like 25/50/25, or 100/300/100. This isn't a secret code. It's the blueprint for your financial safety, and understanding it is non-negotiable. Each of those numbers represents a limit in thousands of dollars. So, a 25/50/25 policy means the first number, 25, stands for $25,000. This is the maximum amount your insurance will pay for any one person's bodily injuries in an accident you cause. The second number, 50, stands for $50,000. This is the maximum amount your insurance will pay for all bodily injuries combined in a single accident you cause. The third number, 25, stands for $25,000. This is the maximum amount your insurance will pay for all property damage you cause in one accident. Now that might sound like a lot of money, but let's put it into a real-world context. Let's say you have that 25/50/25 policy, which is right around the state minimum requirement in many places. You're driving, you glance down at your phone for just a second, and you rear-end a brand new SUV at a stoplight. Let's start with the property damage. That third number, $25,000. A new SUV like a Chevy Tahoe or a Ford Expedition can easily cost over $70,000. Even a moderate rear-end collision can cause over $25,000 in damage, especially with modern sensors, cameras, and crumple zones. If the repair bill is $35,000, your insurance pays its limit of $25,000, and you are personally on the hook for the remaining $10,000. The other driver's insurance company will come after you for it. They will sue you. They will garnish your wages. They will put a lien on your house. All for a simple fender bender. But it gets much, much worse. Let's talk about the people inside that SUV. A family of 3. The driver gets a bad case of whiplash and a minor concussion. The passenger in the front breaks their wrist. The person in the back has some serious back pain. They all go to the hospital. Think about the costs. Ambulance rides are thousands of dollars. An emergency room visit is thousands more. MRIs, X-rays, specialist consultations, physical therapy, the bills stack up at lightning speed. Let's say the driver's medical bills come to $30,000. Your policy's limit for a single person is $25,000. Your insurance pays the $25,000, and you are now personally responsible for the other $5,000. But what about the other 2 passengers? Let's say their bills are $15,000 each. That's another $30,000. So the total medical bills for everyone in the car are $30,000 plus $30,000, which equals $60,000. Your policy's limit for all injuries in one accident, that second number, is only $50,000. So your insurance pays out its max, and you are now being sued for the remaining $10,000 in medical bills, on top of the $10,000 for the car repairs. And we haven't even talked about lost wages, pain and suffering, or attorney's fees. In a split second with a state minimum policy, you are now facing a personal lawsuit that could easily exceed $50,000 or $60,000. That's the terrifying reality of being underinsured. Carrying state minimum liability is one of the biggest financial risks a person can take. It's like trying to protect a fortress with a single security guard. The first sign of trouble, and you're completely overrun. Your life savings, the equity in your home, your future earnings, it's all on the line. All because of a misunderstanding of what your insurance actually does. The purpose of liability insurance isn't just to be legal. It's to build a financial shield between a bad day on the road and the rest of your life. And a flimsy shield is no shield at all. And that's the critical distinction. Liability coverage is you protecting other people from you. It's a financial wall you build around your assets to stop someone else's misfortune, caused by you, from becoming your own financial ruin. But let's be brutally honest for a second. When your car is crumpled on the side of the road, your first thought probably isn't, "Gosh, I hope that other drivers' finances are okay." Your first thought is, "How am I going to fix my car? How am I going to get to work tomorrow? How much is this going to cost me?" And this is where the entire concept of full coverage begins to take shape. Because if you only have liability insurance, the answer to that question, "How much is this going to cost me?" is everything. All of it. The tow truck, the repairs, the rental car, the cost of a new car if yours is totaled. It's all on you. Your insurance company will send you a very polite letter explaining that your policy successfully paid to fix the other person's car. And they will wish you the very best of luck. This is a nightmare scenario that plays out every single day. Imagine you have a paid-off, reliable car. A 5-year-old Honda Accord, let's say. It's worth about $12,000. You're a safe driver, you've never had an accident. You think, why would I pay for extra insurance? I'll just get the state minimum liability. You're saving a solid $50, $60 a month. Feels smart. Then one morning you're running late. The road is a little damp. You glance down at your GPS for just 1 second and bam, you rear-end a brand new Lexus. Everyone's okay, thankfully. But the Lexus has some serious damage. The driver is understandably upset. You exchange information, the police file a report, and you call your insurance company. A few days later, the adjuster calls you back. Good news, he says. The repairs to the Lexus are going to be $22,000. Your policy has a $25,000 property damage limit, so we're going to cover the entire cost. You won't have to pay a penny out of pocket for their car. For a second, you feel a wave of relief. The system worked. Your insurance protected you. But then you ask the question, okay, great, but what about my Honda? It's completely undrivable. The front end is destroyed. And then comes the silence on the other end of the phone. The adjuster clears his throat. Well, sir, looking at your policy, you only have liability coverage. That covers damage you do to others. It doesn't provide any coverage for your own vehicle when you're at fault in an accident. The floor drops out from under you. Your $12,000 asset, the car you rely on every single day, is now a pile of scrap metal. And the $60 a month you save feels like the most expensive mistake of your life. You saved a few $100s over the year, only to lose $12,000 in a single second. This exact situation is why the first major component of full coverage exists. It's called collision coverage. It's that simple. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it could also be a tree, a guardrail, a telephone pole, a garage door you forgot to open, you name it. If you collide with it, this is the coverage that kicks in for you. It doesn't matter who was at fault. If you caused the accident, it pays. If the other driver was at fault but they're uninsured or they flee the scene in a hit and run, it pays. It is your protection for your vehicle in a crash. Now, it's not a blank check. There are two key things to understand about collision coverage: the deductible and the limit. The limit is easy. The most your insurance company will ever pay out is the actual cash value, or ACV, of your car right before the accident happened. So if your $12,000 Honda gets totaled, they'll cut you a check for $12,000 minus your deductible. They're not going to buy you a brand new 2024 model. They're just making you whole for the value of what you lost. The more important part for you to decide on is the deductible. A deductible is the amount of money you have to pay out of pocket for a repair before the insurance company starts paying. Think of it as your share of the cost. Deductibles typically range from $250 to $1,000, or even more. The most common is $500. So let's go back to our Lexus accident. If you had collision coverage with a $500 deductible, the story would have a very different ending. Your car is totaled. Its value was $12,000. You would pay your $500 deductible, and the insurance company would give you a check for $11,500. It's not perfect, you're still out $500, but it's the difference between a manageable inconvenience and a catastrophic financial loss. You can now go buy another reliable car. You can still get to work. Your life isn't derailed. Choosing a deductible is a balancing act. A lower deductible, say $250, means you pay less if you have a claim, but your monthly insurance premium will be higher. A higher deductible, like $1,000, means your monthly premium will be lower, but you need to be sure you can comfortably write a check for that amount if something happens. It's a classic trade-off between saving money now versus paying more later. Okay, so now you're feeling pretty good. You've got your liability to protect your life savings from a lawsuit, and you've got collision to protect your car from, well, collisions. You're covered, right? Not quite. Let's imagine a different scenario. You park your car at the mall. You come back 2 hours later and it's gone. Stolen. Or a massive hailstorm rolls through your town one night, and your car looks like a golf ball the next morning. Or you're driving down a country road and a deer jumps out in front of you. You hit the deer, causing thousands in damage. In all of these cases, what does collision coverage do for you? Absolutely nothing. Why? Because you didn't collide with another car or an object in the traditional sense. These events are often called acts of God, or are just plain bad luck. Stealing a car isn't a collision. Hail isn't a collision. Hitting an animal, surprisingly to many, is not considered a collision by insurance companies. This is the reason for the second major piece of the full coverage puzzle: comprehensive coverage. The official name for it is actually other than collision coverage, which is a perfect description. It covers damage to your car from basically anything other than a collision. This is your protection against the random, unpredictable chaos of the world. It covers theft, vandalism, fire, flooding, hail, windstorms, falling objects like tree branches, and yes, hitting an animal. Just like collision, comprehensive coverage has a deductible that you choose. And just like collision, it pays out up to the actual cash value of your vehicle. Often, people will choose the same deductible for both, like $500, but you don't have to. You could have a lower deductible on comprehensive because claims are often less frequent or severe. For example, getting a cracked windshield replaced is one of the most common comprehensive claims, and some policies even offer a $0 deductible specifically for glass repair. So let's step back and look at the big picture. We now have 3 separate building blocks. 1. Liability coverage. This is for them. It pays for the damage you cause to other people's cars and their bodies. It's your financial shield against the outside world. 2. Collision coverage. This is for you. It pays to fix your car after a crash with an object or another car, regardless of who is at fault. 3. Comprehensive coverage. This is also for you. It pays to fix your car from almost everything else: theft, weather, animals, and other non-collision events. When you hear a car dealer, a lender, or an insurance agent use the term full coverage, this is what they almost always mean. They are talking about a policy that bundles these 3 core protections: liability, collision, and comprehensive. This is the most important takeaway so far. Full coverage is not a single official insurance product you can buy. It's just slang. It's industry jargon, a nickname for a policy that has these 3 ingredients. Without all 3, you don't have what the industry considers full coverage. If your car is financed with a loan or you're leasing it, the bank will almost certainly require you to carry both collision and comprehensive. They have a financial stake in that vehicle, and they want to make sure their investment is protected from both your driving and from random acts of nature. So we've built our shield. Liability protects your assets, collision protects your car in an accident, and comprehensive protects it from everything else. We're done, right? This is it. This is full protection. Not even close. We've only covered property and other people's injuries. We haven't talked about the single most expensive thing that can happen in an accident: injuries to you and your own passengers. What happens if you're hit by a driver with no insurance at all? Who pays for your medical bills, your lost wages, your recovery? Relying on just your health insurance could be a devastating mistake. And that's where the other critical pieces of a truly great insurance policy come in, the ones that protect your body and your own family's well-being. Let's start with a simple, terrifying scenario. You're in a crash. It wasn't your fault. An ambulance is called. You spend a night in the hospital for observation, get some x-rays, maybe some stitches. A few weeks later, the bills start arriving. The ambulance ride alone is over $1,000. The ER visit, thousands more. Your health insurance has a $5,000 deductible you have to meet, plus a 20% co-insurance payment after that. Suddenly, you're on the hook for thousands of dollars out of your own pocket for an accident you didn't even cause. You think, no problem, the other driver's insurance will pay for it. But that can take months of fighting, proving fault, and dealing with adjusters whose entire job is to pay you as little as possible. In the meantime, those medical bills are due now. This is exactly why the first layer of protection for your own body is a coverage called either medical payments or MedPay, or, in some states, personal injury protection, also known as PIP. Think of it as first aid for your finances. It is immediate, no-fault medical coverage. Let me repeat that. No fault. It doesn't matter who caused the accident. If you are injured in your car, or even as a pedestrian hit by a car, this coverage kicks in right away to pay for your initial medical expenses. The ambulance ride, the ER visit, the follow-up with your doctor, chiropractic care, dental work if your teeth were damaged. It's covered instantly up to the limit you select. It pays before your health insurance, meaning you might not even have to touch your high deductible. It covers you, and it covers any passengers in your car, regardless of their own health insurance situation. Now, you might be wondering about the difference between MedPay and PIP. It mostly comes down to where you live. About a dozen states like Florida, Michigan, and New York are what we call no-fault states. In these states, the law says that after an accident, each person's own auto insurance is responsible for their own initial medical bills, regardless of who was at fault. It's designed to speed up the payment process and keep smaller injury claims out of the court system. In these states, you are required to carry personal injury protection, or PIP. PIP is like MedPay on steroids. Not only does it cover medical bills, but it also typically covers other economic losses. The big one, lost wages. If you can't work for 3 weeks because of your injuries, PIP can help replace that lost income. It can also cover things like hiring someone to help with household chores you can no longer do while you recover. In the other 38 states called at-fault or tort states, you have the option of adding medical payments or MedPay coverage. It's generally less comprehensive than PIP. It usually only covers direct medical expenses and doesn't cover lost wages, but it serves that same crucial purpose: getting your immediate bills paid without the headache and delay of fighting the other driver's insurance company. For the relatively low cost, often just a few dollars a month, MedPay is one of the most valuable and tragically overlooked coverages you can have. It bridges the dangerous gap between an accident happening and a settlement being paid. But MedPay and PIP are designed for the immediate aftermath. They typically have limits of a few thousand to maybe $50,000 depending on your state and policy. They are the medics on the battlefield. But what happens when the injuries are not just a trip to the ER, but are life-altering? What happens when your medical bills aren't $5,000 but $500,000? What happens when the person who hit you has no insurance at all? This is not a rare, 1 in a million scenario. According to the Insurance Research Council, about 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. Look at the next 8 cars you see at a stoplight. Statistically, one of them is driving illegally with no liability coverage whatsoever. If that person plows into you and puts you in the hospital for 6 months, their insurance policy is an apology and an empty bank account. You can sue them, sure. You might even win a huge judgment in court. But you can't get blood from a stone. A court judgment is just a piece of paper if the person has no assets, no savings, and no way to pay you. So who pays for your lifetime of medical care? Your lost career? Your pain and suffering? You do. Unless you have the single most important coverage I will talk about in this entire series: uninsured and underinsured motorist bodily injury coverage. Let's call it UM/UM. This is the coverage that protects you from the financial irresponsibility of other drivers. It is your shield against the 1 in 8. Here's how it works. If you are hit and injured by a driver who has no insurance, your uninsured motorist coverage steps in and acts like the insurance policy that driver should have had. It pays for your medical bills, your lost wages, and your pain and suffering, up to the limits you've selected. You're not dealing with a broke driver. You're dealing with your own insurance company, who pays you on that driver's behalf. But what about the second half of that name? Underinsured motorist? This might be even more common and even more insidious. Let's say the driver who hits you isn't uninsured. They're just underinsured. They did the bare minimum the law requires. In many states, the minimum bodily injury liability limit is just $25,000 per person. $25,000. That might not even cover the first day in a modern ICU. So, imagine your medical bills are $200,000. The at-fault driver's insurance company writes you a check for their policy limit of $25 grand. And that's it. They are legally done. They have fulfilled their obligation. You are left with a $175,000 hole. Where does that money come from? It comes from your underinsured motorist or UIM coverage. It steps in and covers the difference between the other driver's pathetic limit and your actual damages, all the way up to the UIM limit you chose on your own policy. This is why the amount of UM/UIM coverage you select is so critical. Many people just check a box for the state minimum, thinking they're covered. But you should always have UM/UIM limits that are at least equal to your own bodily injury liability limits. If you think you are responsible enough to protect other people with $100,000 or $300,000 of liability coverage, then you absolutely must value your own health and your own family's financial future enough to protect yourself with the same amount. You are betting on the financial responsibility of every single stranger you share the road with. With UM/UIM, you're not betting anymore. You're insuring. Now, here's a pro tip that your insurance agent might not even tell you about. A powerful feature hidden in the fine print: stacking. If you have more than one car on your auto insurance policy, some states and companies allow you to stack your uninsured/underinsured motorist coverage. Let's say you have 2 cars, and you have $100,000 of UM coverage on each one. If you choose stacked coverage, in the event of an accident with an uninsured driver, you don't just have $100,000 of coverage. You have $200,000. You are allowed to combine or stack the limits for each car on your policy, creating a much larger pool of money to draw from in a catastrophic claim. If you have 3 cars, it would be $300,000. It costs a little more, but in a worst-case scenario, that extra coverage could be the difference between a full recovery and a lifetime of debt. Some companies will have you sign a form to specifically reject stacking. They want you to reject it because it represents a huge risk for them and a huge benefit for you. Never ever reject it if you have the option. So let's recap. We've now built the armor that protects you and your family. We have MedPay or PIP for the immediate, no-fault medical bills to stop the financial bleeding right away. And we have the knight in shining armor, uninsured and underinsured motorist coverage, to protect you from the devastating financial fallout of being hit by one of the millions of irresponsible drivers on the road. We've covered your car from damage and we've covered your body from injury. We've built a fortress. But what about the daily life stuff? The inconveniences and hidden costs that come with an accident? What about paying for a rental car while yours is in the shop for 3 weeks? What happens if you break down on the side of the highway at 2 a.m.? These might seem like small details, but they can turn a stressful situation into an absolute nightmare. And that's where the final pieces of a true full coverage policy come in. The optional, but incredibly valuable coverages that smooth out all the rough edges of an accident. Let's start with one of the most common and frustrating headaches after a crash. You're not hurt, the other driver's insurance is handling the repairs, everything seems to be going smoothly. Until the body shop tells you it's going to take 3 weeks to get the parts and fix your car. 3 weeks. 21 days without a vehicle. How do you get to work? How do you take your kids to school? How do you go grocery shopping? You're forced to rent a car, and you watch in horror as the bill climbs higher and higher, $35, $50, even $75 a day. By the time you get your car back, you could be facing a bill for over $1,000, an unexpected gut punch to your budget that nobody warned you about. This is where the first of these crucial add-ons comes in: rental reimbursement coverage. For what often amounts to just a few dollars a month, less than a single fancy coffee. This coverage pays for a rental car while yours is being repaired after a covered claim. It's not unlimited. Your policy will specify a daily limit, say $30 or $50 a day, and a maximum total, like $900 or $1,500. But having this coverage is the difference between a minor inconvenience and a major financial crisis. It's the peace of mind of knowing that your life doesn't have to grind to a halt just because your car is in the shop. It's one of those things that seems like a small, unnecessary expense until the day you desperately need it, and on that day it feels like the single smartest decision you've ever made. Okay, so you've got a way to pay for a rental, but how did your damaged car even get to the body shop? Let's rewind the clock. Imagine it's not a major accident. It's 10 p.m. on a Sunday night. You're driving home on a dark, unfamiliar back road when you hit a nasty pothole you never saw coming. You hear a loud bang, followed by that dreaded thumping sound. Flat tire. You pull over miles from the nearest town with spotty cell service. Maybe you know how to change a tire, maybe you don't. Maybe your spare is flat, or you don't have the right tools. Or maybe it's worse. Maybe the engine just died, smoke pouring from under the hood. You're stranded. The tow truck you finally managed to call quotes you a price of $250 just to show up and haul you to the nearest mechanic, who won't even be open until morning. This is the scenario that towing and labor or roadside assistance was built for. This is another one of those incredibly inexpensive coverages that can feel like a superpower when you need it. For a few extra bucks on your policy, you get a 24/7 hotline to call for help. They'll dispatch a truck to tow you to a repair shop. They'll send someone to jumpstart your dead battery, bring you a gallon of gas if you run out, or help you change that flat tire. It transforms a moment of pure panic and vulnerability into a managed problem. Instead of frantically searching for a tow company and worrying about the exorbitant cost, you just make one call. You're taken care of. It's not just about the money you save on a tow. It's about the safety, the security, and the immediate relief of knowing help is on the way. Now we've covered your car, your rental, and getting you off the side of the road. But we need to talk about the most important thing involved in any accident: the people. Specifically, you and your passengers. Let's say you're an offender bender. It wasn't your fault. The other driver's bodily injury liability should cover your medical bills, right? Well, yes, eventually. But first, fault has to be officially determined. The insurance companies might argue. It can take weeks, even months, for that other policy to pay out. In the meantime, the hospital, the physical therapist, the chiropractor, they all want to be paid now. Your own health insurance might cover it, but you could have a high deductible of thousands of dollars that you have to pay out of pocket first. This is where medical payments coverage, or MedPay, becomes your financial first aid kit. MedPay is optional in most states, and it covers medical expenses for you and your passengers, regardless of who was at fault. It kicks in immediately. You go to the emergency room for a checkup after an accident? MedPay can cover the copay or the bill up to your coverage limit, which is typically between $1,000 and $10,000. There's no waiting for fault to be assigned, no fighting with another insurance company. It's fast, direct, and designed to handle those immediate costs, so you can focus on getting better, not on the incoming bills. In some states, particularly no-fault states, this concept is taken a step further with personal injury protection, or PIP. PIP is like MedPay on steroids. Not only does it cover medical bills regardless of fault, but it can also cover other essential expenses that arise from your injury. The biggest one? Lost wages. If your doctor says you can't work for 3 weeks because of a concussion you sustained in the crash, PIP can reimburse you for a percentage of your lost income. It can also cover things like childcare expenses if you're unable to care for your kids, or the cost of hiring someone to do household chores you can no longer perform. PIP provides a much wider, more robust safety net to ensure an injury doesn't just hurt you physically, but also trigger a devastating financial domino effect. Now, we have to talk about the single most important optional coverage you can possibly have. It's the one that protects you from the scariest scenario of all. Imagine you do everything right. You're a safe driver. You have great insurance, liability, collision, comprehensive, rental, roadside, the works. You're stopped at a red light and suddenly, bam, you're rear-ended by someone texting and driving. Your car is totaled. You're injured. It's clearly their fault. But as you exchange information, you get that sinking feeling in your stomach. The other driver looks nervous. They admit they don't have insurance. Or, almost as bad, they have the absolute bare minimum coverage required by the state, say $25,000 for property damage. But you were driving a brand new $50,000 SUV. Their insurance pays out its max and you are still short $25,000 on your car loan, not to mention your own medical bills are piling up. Who pays the rest? The answer is terrifying: you do. You are left holding the bag for someone else's mistake. This is not a rare occurrence. The Insurance Research Council estimates that about 1 in every 8 drivers on the road in the United States is uninsured. That's more than 12%. In some states, it's as high as 1 in 4. You are sharing the road every single day with millions of people who cannot pay for the damage they cause. This is where uninsured and underinsured motorist coverage, or UM/UIM, becomes your shield. This coverage is so vital, it's actually required in some states. It steps in and acts like the insurance policy the other driver should have had. Uninsured motorist coverage protects you if you're hit by someone with no insurance at all, or in a hit and run. It will pay for your medical expenses, uninsured motorist bodily injury, and in some states the repairs to your car, uninsured motorist property damage. Underinsured motorist coverage kicks in when the at-fault driver has insurance, but their policy limits are too low to cover all of your bills. Pays the difference up to the limits you select. So in our example, if your $50,000 SUV was totaled by someone with only $25,000 in coverage, your underinsured motorist policy would step in to cover that remaining $25,000 gap. Choosing your UM/UIM limits is simple. You should always select limits that are equal to your own bodily injury and property damage liability limits. You are essentially buying a policy to protect yourself with the same level of coverage you're required to have to protect others. It is the ultimate defensive move, ensuring that your financial security isn't destroyed by the irresponsibility of a total stranger. These coverages, rental, roadside, MedPay, and especially uninsured motorist, are what truly fill in the gaps. They take a standard policy and transform it into a comprehensive fortress of protection, designed not just for the big, obvious disasters, but for all the messy, frustrating, and financially draining details that come with them. So let's talk about the bricks and mortar of that fortress. These are the specific, often optional coverages that plug every potential hole in your financial defenses. They are the difference between a policy that just covers the crash and a policy that covers the aftermath of the crash. First up is one of the most underrated, yet most frequently used add-ons: rental reimbursement coverage. Imagine this scenario. You're in a not-at-fault accident. The other driver's insurance has accepted liability, but their adjuster is slow. Your car, the one you rely on to get to work, to get your kids to school, to live your life, is sitting in a body shop. The mechanic tells you it's going to be 3 weeks. 3 weeks. That's 15 work days. Suddenly, you're staring down the barrel of a massive bill from a rental car company. We're talking $50, $60, maybe $70 a day. Over 3 weeks, that's well over $1,000 out of your own pocket, just so you can continue to function while you wait for repairs you didn't even cause. This is where rental reimbursement swoops in. For a few extra dollars on your premium each month, your insurance company will cover the cost of a rental car, up to a certain daily limit and for a certain number of days. It turns a $1,000 catastrophe into a minor inconvenience. It's the coverage you don't think you need until your life is suddenly at a standstill, and the only thing that can get it moving again costs $65 a day plus tax. Next, let's talk about the moment we all dread. The flashing lights in your rearview mirror. Not from the police, but from a tow truck. I'm talking about roadside assistance. Picture yourself on a long road trip. You're in the middle of nowhere, miles from the next town, and suddenly you hear that dreaded thump thump thump. A flat tire. Or maybe it's worse. The engine sputters and dies. You're stranded. It's late, it's getting dark, and you have no idea who to call. You start frantically Googling towing near me, and the prices you see are staggering. $100 just for the hookup, plus $5 a mile. You're 100 miles from a decent mechanic. You do the math in your head and feel sick. Roadside assistance coverage is your guardian angel in this moment. It's a 24/7 hotline to safety. With one call, they'll dispatch a truck to your exact location. They can change a flat tire, jumpstart a dead battery, bring you a few gallons of gas if you run out, or tow your vehicle to the nearest qualified repair shop. Instead of a $500 surprise bill and a night of panic, it's a simple phone call and a feeling of profound relief. It's an incredibly cheap addition to your policy that buys you invaluable peace of mind on every single trip. Now let's move from the car to the people inside it. This is where we talk about medical payments coverage or MedPay, and its more comprehensive cousin, personal injury protection or PIP. Depending on your state, you'll typically have access to one of these. Think about this. You're driving with a friend in the passenger seat. You get into a minor fender bender, and your friend bumps their head on the side window. It doesn't seem serious at first, but they want to get it checked out at an urgent care clinic just to be safe. Who pays for that visit? Who pays for the X-ray? Without MedPay or PIP, it becomes a complicated, awkward mess of health insurance deductibles and potentially waiting for the at-fault party's insurance to pay up. But with MedPay, it's simple. This coverage pays for immediate, necessary medical expenses for you and your passengers, regardless of who was at fault for the accident. It covers things like ambulance rides, emergency room visits, co-pays, and deductibles from your health insurance. It's designed to be fast, no questions asked coverage to handle the immediate aftermath. PIP, which is mandatory in some states, goes even further. It not only covers medical bills but can also reimburse you for lost wages if you can't work, and even for services you can no longer perform, like childcare or house cleaning. It's a safety net for your health and your income, ensuring that a physical injury doesn't immediately spiral into a financial one. But perhaps the most important piece of this fortress, the one that protects you from the biggest unknown on the road, is uninsured and underinsured motorist coverage. This one is critical. Let's paint a starkly realistic picture. You are a responsible driver. You have great insurance, you have liability, collision, comprehensive, all the bells and whistles we've discussed. You're stopped at a red light when suddenly, bam, you're rear-ended by someone texting and driving. Your new car is crumpled, your back is in agony, and the person who hit you gets out of their car and says the 5 words that will make your stomach drop. I don't have insurance. What now? Their irresponsibility just became your nightmare. Your collision coverage will fix your car, sure, after you pay your deductible. But what about your medical bills? Your lost wages from being unable to work? The months of physical therapy you're now facing? The other driver has no insurance company to sue. You could try to sue them personally, but the reality is, if they can't afford insurance, they almost certainly can't afford to pay a multi-$1,000 judgment. You're left holding the bag for their mistake. This is where uninsured motorist coverage saves you. It steps in and acts as the insurance the other driver should have had. Your own insurance company pays for your medical bills, your pain and suffering, and your lost income, up to the limits you selected. Underinsured motorist coverage works similarly, but for situations where the at-fault driver has insurance, but their liability limits are pathetically low and aren't enough to cover your extensive injuries. Fills that gap. This isn't just insurance. It's protection from the financial recklessness of others. Finally, we have to talk about the one that new car owners cannot afford to ignore: gap insurance. GAP stands for Guaranteed Asset Protection, and it covers one of the most financially devastating scenarios in modern car ownership. You just bought a beautiful brand new car. You financed $30,000 to get it. You drive it off the lot and, as you know, it immediately depreciates in value. 2 months later, through no fault of your own, the car is totaled in an accident. Your insurance company does their job. They assess the car's actual cash value, its market value at the moment of the crash, and they determine it's worth $25,000. They write you a check. But here's the problem. Because of interest in that initial depreciation, you still owe the bank $29,000 on your loan. The insurance check pays off most of it, but you are now left with a $4,000 bill for a car that no longer exists. You have no vehicle, and you're still cutting a check to the bank every month. It is a financial trap. Gap insurance is designed specifically for this nightmare. It pays the difference, the gap, between what your insurance pays out and what you still owe on your loan or lease. For anyone who is financing a new vehicle, especially with a small down payment, gap insurance isn't a luxury. It's an absolute necessity that prevents a total loss of your car from also becoming a total financial disaster. Each of these coverages is a specialized tool designed to solve a very specific, very real, and very expensive problem that the core liability and physical damage policies just weren't built to handle. So let's open up that toolbox and examine these specialized instruments of financial protection, starting with the one that addresses every driver's single biggest nightmare. Imagine this. You're driving home, waiting at a red light, minding your own business. Suddenly, from out of nowhere, bam, a car plows into your rear bumper at 40 miles an hour. It's a violent, terrifying jolt. Your car is a wreck, your neck is in excruciating pain, and you're shaken to your core. The other driver is clearly 100% at fault. They ran a red light. After the initial shock wears off, a small sense of relief trickles in. It's a horrible situation, but at least their insurance will pay for everything, right? For your totaled car, for your hospital visit, for the physical therapy you're definitely going to need. But then the police officer comes over to you with a grim look on his face. He says, "I'm sorry, but the other driver, they don't have insurance." In that moment, your stomach drops. The entire financial burden of someone else's catastrophic mistake just landed squarely on your shoulders. Your $10,000 car is now a worthless pile of metal. Your medical bills are already starting to climb. How are you going to pay for this? Are you just out of luck? This is where the first and arguably one of the most important, optional coverages rides in to save the day: uninsured and underinsured motorist coverage. Think of it as your own insurance company stepping in to wear the hero's cape when the villain gets away scot-free. This coverage essentially takes the place of the at-fault driver's non-existent or inadequate insurance policy. It's not one thing. It's usually broken down into 2 or 3 parts. First, you have uninsured motorist bodily injury, or UMBI. This is the big one. This pays for your medical expenses and the medical expenses of your passengers when you're hit by a driver with no insurance. It also covers things your health insurance won't touch, like lost wages if your injuries prevent you from working. If you're a freelance graphic designer and you can't sit at a computer for 2 months because of a back injury from the crash, this coverage can replace that lost income. It can also compensate you for pain and suffering, a concept that acknowledges the real, human cost of an accident beyond just the medical bills. Without UMBI, you'd have to sue the uninsured driver personally. And let's be honest, if they can't afford a basic insurance policy, the odds of them having tens of thousands of dollars in assets to pay you are practically zero. Next is its partner, uninsured motorist property damage, or UMPD. This, as the name implies, pays to repair or replace your car when it's damaged by an uninsured driver. Now you might be thinking, wait, doesn't my collision coverage already do that? And you're right, it does. If you have collision, it will pay for your car's repairs regardless of who is at fault, even an uninsured driver. So why have UMPD? Well, in some states, the deductible for a UMPD claim is much lower than your collision deductible. So instead of paying a $500 or $1,000 deductible, you might only pay $250. It's a small detail, but it can save you real money. In some states, you can't even buy UMPD if you already have collision, so it's critical to know the rules where you live. Now let's tweak our nightmare scenario slightly. What if the driver who hit you does have insurance, but it's only the absolute bare minimum required by law? In some states, that might be as low as $15,000 or $25,000 for bodily injury. That sounds like a lot of money, but a single night in the hospital and MRI, and a few weeks of physical therapy can burn through that amount frighteningly fast. If your medical bills are $80,000, but the at-fault driver's policy maxes out at $25,000, you're left with a $55,000 gap. This is where the underinsured part comes in. underinsured motorist coverage or UIM bridges that exact gap. After the other driver's insurance pays its limit, your UIM coverage kicks in to cover the rest, all the way up to the limit you selected on your own policy. Together, uninsured and underinsured motorist coverages are your personal shield against the massive and growing problem of irresponsible drivers. They ensure that your financial future isn't destroyed by someone else's refusal to follow the law. In some states, this coverage is mandatory, but in many, it's an option. An option, in my opinion, no driver should ever be without. Okay, let's move to the next set of specialized tools, which are designed to provide immediate relief right after an accident, regardless of who was at fault. These are medical payments coverage, often called MedPay, and personal injury protection or PIP. Think of MedPay as your car's on-call first aid kit. It's a relatively small amount of coverage, usually ranging from $1,000 to $10,000, that pays for immediate medical and funeral expenses for you and anyone in your car who is injured in an accident. The magic of MedPay is its simplicity and speed. It doesn't care who was at fault. It doesn't wait for police reports or insurance adjusters to argue for weeks. You go to the emergency room, you show them your MedPay info, and the bill gets paid right up to your limit. It's perfect for covering your health insurance deductible, co-pays, or for things your health insurance might not cover, like a dental injury or an ambulance ride. Personal injury protection or PIP is like MedPay on steroids. It's most common in what are called no-fault states. In these states, the law says that after an accident, each driver's own insurance pays for their own injuries first, up to a certain limit, to speed up the process and keep smaller claims out of the courts. PIP is the mechanism for that. Like MedPay, it covers medical bills regardless of fault, but it goes much further. PIP also typically covers a percentage of your lost wages, and critically, it can pay for replacement services. For example, if you're a stay-at-home parent and a broken leg from an accident means you can't take care of your kids, PIP can help pay for childcare. It's a much more comprehensive safety net for the immediate aftermath of a crash. So we've protected ourselves from uninsured drivers, and we've set up a fund for immediate medical needs. But what about the practical day-to-day headaches that come with a car accident? What about just getting around? This brings us to our last two specialized tools for this section: the ultimate convenience coverages, rental reimbursement and towing and labor. Let's go back to our crash scenario. Your car is too damaged to drive. The body shop says they need it for 12 days to do the repairs. How do you get to work for the next 2 weeks? How do you take your kids to school? Drop off the dry cleaning? Go grocery shopping? You need a car. Renting one costs, let's say, $45 a day. Over 12 days, that's $540 that you did not plan to spend. This is exactly what rental reimbursement coverage is for. For a tiny cost per month, often just a few dollars, this coverage will pay for a rental car while yours is being repaired after a covered claim. It's usually sold with a daily limit and a total limit, for example, $30 a day up to a maximum of $900. It takes a huge logistical and financial headache completely off your plate. And finally, the simplest, cheapest, and sometimes most welcome coverage of all, towing and labor, also known as roadside assistance. You're driving late at night and your tire blows out on the highway. Your battery dies in an airport parking lot. You lock your keys in the car. These aren't accidents, but they are major pains. A tow can easily cost $150 or more. Roadside assistance coverage turns that expensive emergency into a simple phone call. For pennies a day, it covers the cost of a tow to the nearest repair shop, a jump start, a tire change, fuel delivery if you run out of gas, or a locksmith. It's the ultimate peace of mind policy for the everyday problems of car ownership. So you can see, these aren't just random add-ons. They are specific solutions to specific, expensive problems. Uninsured motorist protects you from the irresponsible. MedPay and PIP provide immediate medical care. Rental and towing handle the logistical nightmares. Together, they create a comprehensive shield, transforming a basic insurance policy into a true fortress of financial security. So now we've built our fortress of coverage. We have our liability walls, our collision and comprehensive roof, and all of these specialized tools reinforcing the structure. But how strong are the walls? How high is the gate? Because choosing the right numbers, the limits and deductibles, is the difference between a fortress and a cardboard box. And that's exactly where most people make the biggest, most expensive mistake. Let's start with the easiest number to understand: your deductible. Think of it as the cover charge you have to pay to get into the My Insurance Company will now pay for my car club. It's the amount of money you agree to pay out of pocket for repairs to your own vehicle before your collision or comprehensive coverage kicks in. Let's say you have a $500 deductible. You back into a pole, causing $2,000 in damage. You pay the first $500, and your insurance company pays the remaining $1,500. Simple enough. Now here's the trap. Insurance companies will dangle a very tempting carrot in front of you. A lower monthly premium if you choose a higher deductible. A $1,000 deductible might save you $15 a month compared to a $500 one. A $2,000 deductible might save you even more. And the math magician in your brain says, hey, I'll save hundreds of dollars a year. But what you're really doing is making a bet. You're betting against yourself. You're betting that you won't get into an accident. And you're betting that if you do, you'll just happen to have $1,000 or $2,000 in cash sitting around, ready to be handed over to a body shop on a moment's notice. How many of us can honestly say that? That's the first crack in the wall of your fortress. Choosing a deductible isn't about saving money per month. It's about choosing a number you could comfortably pay tomorrow without derailing your entire financial life. If writing a check for $1,000 would mean you can't pay rent, your deductible is too high. Period. But as scary as that is, the deductible is just the gatekeeper to your own little castle. The real danger, the invading army that can level your entire financial kingdom, comes from the other side of the crash. It comes from the damage you do to other people and their property. And this is governed by the most misunderstood, yet most important numbers on your entire policy, your liability limits. When you look at your insurance card, you'll see a series of numbers that looks like a secret code. Something like 25/50/25, or 50/100/50, or 100/300/100. This isn't just jargon. This is the exact blueprint of your financial fortress. This is its height, its thickness, its strength. Let's break down the code. The first number is the maximum amount in thousands of dollars your insurance will pay for bodily injury to a single person in an accident you cause. So a 25 means your insurance will cover up to $25,000 of medical bills for any one person you injure. The second number is the maximum amount your insurance will pay for bodily injury for the entire accident, no matter how many people are hurt. A 50 means that if you injure 3 people, the insurance company's total payout for all their medical bills combined cannot exceed $50,000. The third number is the maximum amount your insurance will pay for property damage you cause in an accident. A 25 here means they'll pay up to $25,000 to repair or replace any cars, fences, mailboxes, or buildings you might hit. Now, here is the single most terrifying fact about auto insurance in America. Every state has a legal minimum for these liability limits. And in many states, that minimum is shockingly catastrophically low. Some states still have minimums of 25/50/25 or even lower. And millions of drivers trying to save money and just be legal select these state minimums. They are building their fortress out of cardboard. Let's see what happens when that cardboard box gets hit by the freight train of reality. Meet Dave. Dave is a responsible guy. He pays his bills, he works hard. He got a great deal on his insurance by choosing his state's minimum coverage, 25/50/25. He's saving about $40 a month. A smart move, he thinks. One rainy afternoon, Dave glances at his phone for just a second. In that second, the car in front of him, a brand new Tesla Model Y, slams on its brakes. Dave rear-ends it, and the force shoves the Tesla into the minivan in front of it. It's a classic chain reaction. No one is seriously hurt, thankfully, but the dad driving the minivan has a sore neck and his 2 kids in the back are shaken up and get checked out at the hospital. The Tesla's driver is fine, but his car, well, it's a mess. The dust settles. The tow trucks leave. And then the bills start to arrive. First, the property damage. The minivan has about $5,000 in damage. No problem, Dave's policy can handle that. But the Tesla, with its advanced sensors, cameras, and battery systems, the repair estimate comes in at $32,000. Dave's property damage limit is $25,000. The insurance company writes a check for $25,000, their maximum responsibility. Where does the other $7,000 come from? Comes from Dave. He is now personally legally on the hook for $7,000. His $40 a month savings are looking pretty bad right about now. But it gets so much worse. Now come the medical bills. The dad in the minivan went to the ER, got an MRI on his neck, and needs a few weeks of physical therapy. His bill totals $18,000. Dave's insurance covers it. His limit is $25,000 per person, so he's good there. But the two kids were also taken to the hospital for precautionary checkups and CT scans. Their bills are $7,000 each. That's another $14,000. So let's add it up. $18,000 for the dad, plus $14,000 for the kids. That's a total of $32,000 in medical bills. But remember the second number on Dave's policy? The 50? That means his insurance will only pay a maximum of $50,000 for all injuries in the accident. So far he's at $32,000. He's still safe, right? Wrong. A week later, the dad's lawyer calls. The dad is a freelance graphic designer, and because of his neck injury, he couldn't work for a month. He's suing for $25,000 in lost wages. Suddenly, the total bodily injury claim isn't $32,000 anymore. It's $57,000. Dave's insurance company looks at the numbers. They see a total claim of $57,000. They look at Dave's policy, which has a maximum payout of $50,000. They pay the $50,000, and then they wish Dave the best of luck, because he is now personally on the hook for the remaining $7,000. Let's tally up Dave's savings. He owes $7,000 for the Tesla. He owes another $7,000 for the bodily injury claim. That's a $14,000 bill. All to save $40 a month. He would have had to go without an accident for almost 30 years just to break even. And this was a relatively minor accident. What if the car he hit was a $90,000 Porsche? What if someone needed surgery? What if his 25/50/25 policy was up against a $200,000 medical bill and a totaled luxury SUV? The numbers become astronomical. We're talking about $100,000, $200,000 lawsuits. And when that happens, they don't just ask you to pay. They take it. They will garnish your wages, meaning a chunk of every single paycheck you earn goes to them for years, maybe even decades. They can put a lien on your house. They can seize your assets, your savings, your investments. Everything you've worked for, and everything you will work for in the future, can be wiped out in the blink of an eye, all because of three little numbers on an insurance policy. Now imagine Dave had a different policy. Imagine he built a fortress. Instead of 25/50/25, he had 100/300/100. The cost difference for this kind of upgrade is usually shockingly small. Maybe the price of 2 lattes a month. Let's rerun the accident. The $32,000 Tesla repair? His $100,000 property damage limit covers it completely. The $57,000 injury and loss wages claim? His $100,000 per person and $300,000 per accident limits handle it without even breaking a sweat. In this scenario, Dave pays his deductible to fix his own car. And that's it. He writes one check and he walks away. His savings are safe. His house is safe. His future is safe. The fortress held. So I ask you, look at your own policy. What are your numbers? Are you driving around in a fortress made of stone? Or one made of cardboard, hoping it doesn't rain? Because increasing your liability limits is the single most important, most impactful, and most cost-effective thing you can do to protect your entire financial life. It is the difference between an inconvenience and a catastrophe. But even this fortress has a secret weapon, a hidden layer of defense that can protect you from the million-dollar disasters that haunt every driver's nightmares. This is the scenario that keeps insurance adjusters up at night. It's the one every driver thinks will never happen to them. You're driving home on the interstate. Maybe you're a little tired. For a split second, you glance down at your phone. In that 1 second, the car in front of you slams on its brakes. You swerve to avoid it, clipping its bumper and sending your own car spinning across 2 lanes of traffic. The result is a horrifying chain reaction pileup involving 4 other vehicles. In one of those cars is a neurosurgeon. His hand is crushed in the accident. He'll live, but his career, a career he spent 15 years and hundreds of thousands of dollars in education to build, is over. The lost future income, combined with his medical bills, is valued at $2 million. In another car, a family of 4 suffers serious injuries, with medical costs soaring to $500,000. The other cars are mangled heaps of metal, totaling over $100,000 in property damage. The lawsuits come fast. The total damages against you add up to $2.6 million. You were a responsible person. You had good liability coverage, let's say the often recommended 250/500/100 limits. Your policy pays the maximum it can. It pays $500,000 for all the bodily injuries combined, and $100,000 for all the property damage. Your insurance company writes checks for a total of $600,000, and then they're done. Their legal obligation to you is fulfilled, but you still owe $2 million. $2 million. That number is no longer an abstract figure. It is a judgment against you. It is a legal chain attached to everything you own, and everything you will ever own. Your house? A lien is placed on it, and it's sold to pay the debt. Your retirement accounts? Drained. Your kids' college fund? Gone. Your savings? Wiped out. And after all of that, you still owe over $1 million. So the court garnishes your wages. For the next 20, 30, maybe 40 years, a significant portion of every single paycheck you earn goes directly to paying off this one single mistake. You are, for all practical purposes, working for free for the rest of your life. Your financial future and your family's has been utterly and completely annihilated. This is the $1 million disaster. And the secret weapon, the hidden layer of defense against this exact nightmare, is called an umbrella policy. It's called an umbrella policy for a reason. Imagine your auto insurance and your homeowner's insurance are two strong walls protecting your assets. An umbrella policy is like a massive, reinforced roof that sits on top of both of those walls. It doesn't replace them. It works with them. It is a secondary layer of liability protection that only kicks in after your primary insurance policies have paid out their maximum limits. Here's how it works. You can't just go out and buy an umbrella policy on its own. Insurance companies require you to have a solid foundation first. They will mandate that you carry a certain minimum amount of liability coverage on your underlying policies. Typically, this means you'll need auto liability limits of at least $250,000 per person and $500,000 per accident, and homeowners liability of at least $300,000. These are your underlying limits. Once you have this primary protection in place, you can then purchase an umbrella policy, which is sold in increments of $1 million. Now let's rewind that horrific highway catastrophe. Same accident, same $2.6 million judgment. But this time you had a $2 million umbrella policy. First, your auto insurance policy steps up to the plate. It does exactly what it did before. It pays out its maximum of $500,000 for bodily injury and $100,000 for property damage. It exhausts its limits. Now, instead of lawyers coming after your house and your life savings for the remaining $2 million, your umbrella policy unfurls. It activates. It seamlessly takes over where your auto policy left off, covering the entire remaining $2 million balance. The neurosurgeon is compensated. The injured family is taken care of. And you? You write a check for your deductible, which might be zero, and you walk away. Your house is safe. Your retirement is safe. Your future earnings are your own. The financial apocalypse that was bearing down on you has vanished. For the cost of what is often less than $1 a day, you have just saved yourself from a lifetime of financial ruin. This is the single most incredible part about umbrella insurance. It is shockingly inexpensive for the colossal amount of protection it provides. A $1 million personal umbrella policy typically costs between $150 and $350 per year. $2 million in coverage might only be $100 more. Why is it so cheap? Because the insurance company is betting that you'll never need it. Major catastrophic claims that exceed $500,000 are statistically rare. Your primary auto and home insurance handle the fender benders, the slip and falls, the everyday claims. The umbrella policy is there for the black swan event, the statistical anomaly, the absolute worst day of your life. And because it's so rarely used, the risk for the insurer is lower, and so is your premium. A common misconception is that umbrella insurance is only for the rich. This could not be further from the truth. In fact, it's arguably more important for the middle class. A billionaire might be able to absorb a $2 million lawsuit. But for a family with a home, 2 cars, and $200,000 in a 401k, a lawsuit of that size isn't just a setback, it's a complete wipeout. It erases decades of hard work and saving in an instant. You don't need to be a millionaire to be sued like one. The real question is not how much are you worth today, but how much could you earn over the rest of your life? If you're a young professional, a doctor, a software engineer, an entrepreneur, your future earning potential is your single greatest asset. A major lawsuit can put a lien on that potential for the rest of your career. An umbrella policy protects not just the assets you have, but the future you are trying to build. And its protection extends far beyond your car. Remember, it sits over your homeowner's policy too. Your teenager throws a party while you're away, and someone is seriously injured. Your dog gets loose and bites a child in the neighborhood. You post a negative review of a local business online, and they sue you for libel and defamation. In all of these scenarios, once your homeowner's liability limit is reached, your umbrella policy kicks in to protect you. It's a comprehensive shield for your personal liability in almost every facet of your life. Liability coverage is about protecting you from the damage you can do to others. And by combining high limits on your auto policy with a personal umbrella policy, you are creating a financial fortress that can withstand almost any storm. You've insulated your life's work from a single catastrophic mistake. But this fortress, as strong as it is designed to protect you from claims you cause. There's another more insidious threat out on the road. A threat that comes from the other side. What happens when the person who hits you has no insurance at all? That is the ghost in the machine we need to confront next. This ghost is not a supernatural entity. It's a statistical certainty. Right now, as you're watching this, 1 in every 8 drivers on the road around you has no car insurance. In some states like Mississippi, it's 1 in 4. Think about that. On your daily commute, you will pass dozens, maybe hundreds of cars, and a significant fraction of them are financial time bombs driving at 60 miles per hour. They are ghosts in the system. If they make a mistake and plow into your car, they have no liability coverage to pay for the damage they caused. They have no assets to sue for. They simply vanish. They exchange information that turns out to be fake, or they just speed away, leaving you on the side of the road with a wrecked car, a potential injury, and a sickening feeling in your stomach. You might think, that's okay, I have full coverage. My collision insurance will fix my car. And you'd be right about the car. You'd pay your deductible, your insurance company would fix your vehicle, and that part of the nightmare would be over. But what about you? What if your back is injured? What if you can't work for 3 months? What if you have $100,000 in medical bills? Your collision coverage won't touch that. Your comprehensive coverage won't touch that. And the at-fault driver? They're a ghost. There's no one to sue, no insurance company to make a claim against. You are left holding the bag for a catastrophe you did not cause. This is the single biggest, most terrifying gap in a standard auto insurance policy. This is where your full coverage can reveal itself to be a hollow promise. Unless, that is, you have the ghost hunters. This protection has a specific name: uninsured and underinsured motorist coverage, often abbreviated as UM/UIM. This isn't just an add-on. It is arguably one of the most important coverages you can buy, because it protects you from the irresponsibility of others. Let's break it down because there are 2 distinct phantoms we're fighting here. First is the uninsured motorist, the UM. This is the driver with zero insurance, or the hit-and-run driver who can't be identified. When you have uninsured motorist coverage, your own insurance company steps into the shoes of the ghost driver. They essentially pretend to be the at-fault driver's insurance company and pay you for the damages they would have owed. It comes in 2 flavors, just like liability: uninsured motorist bodily injury, or UMBI, and uninsured motorist property damage, or UMPD. UMBI is the absolute hero of this story. It covers your medical bills, your passengers' medical bills, lost wages if you can't work, and even pain and suffering. It is the only thing that protects your physical and financial health when you're injured by an uninsured driver. Without it, you are completely on your own. Your health insurance might cover some of the bills, but it won't pay you for the 6 months of work you missed while recovering. It won't compensate you for the chronic pain you now have to live with. UMBI does that. Then there's UMPD, which covers the damage to your car. Now you might be thinking, wait, didn't you say my collision coverage would do that? Yes, it would. So why have UMPD? 2 reasons. First, UMPD deductibles are often much lower than collision deductibles. We're talking maybe $250 instead of $1,000. Second, if you don't have collision coverage at all, maybe because you have an older paid-off car, UMPD is the only thing that will pay to fix your car after a hit and run. It's a crucial backstop. So that handles the ghost, the driver with no insurance. But there's a second, more subtle threat. It's not a ghost, it's a zombie. It looks like it's covered, it acts like it's covered, but when you get up close, you realize it's just a hollowed-out shell. This is the underinsured motorist. The underinsured motorist, or UIM, is the driver who did the absolute bare minimum. They bought the cheapest policy they could find to be legally on the road. Let's take a state like Florida, for example, where the minimum requirement for bodily injury liability is just $10,000 per person. $10,000. What does that cover in today's world? An ambulance ride and a few hours in the emergency room? It's gone in an instant. So let's paint the picture. You're sitting at a red light. A driver, distracted by their phone, slams into you from behind. The accident is 100% their fault. Your car is totaled, and you suffer serious neck and back injuries that require surgery and months of physical therapy. Your total medical bills come to $150,000. You're out of work for half a year, losing another $40,000 in income. The total cost of this accident to you is nearly $200,000, not even counting the car. You file a claim against the at-fault driver's insurance, and their adjuster calls you back and says, "We're very sorry this happened. Our client has a state minimum policy. We will be tendering our full policy limits of $10,000. They cut you a check for $10,000, and that's it. That is all they are legally obligated to pay. You are now left with a $190,000 hole in your life. What do? You can try to sue the driver personally, but if they could only afford a $10,000 policy, what are the odds they have $190,000 in assets for you to take? The odds are close to zero. This is where underinsured motorist, or UIM coverage saves your life. Your UIM coverage kicks in where the other driver's policy leaves off. If you have UIM coverage with limits of say $250,000, the math works like this. Your policy limit is $250K. The other driver paid out $10K. So your own insurance company will step in and cover the remaining gap, up to an additional $240,000. They cover your remaining medical bills. They cover your lost wages. They make you whole. Without UIM, your financial life is very likely ruined by someone else's mistake and their decision to buy cheap insurance. This is why when you select your liability limits, that 100/300/100 we talked about earlier, it is critically important to select the exact same limits for your uninsured and underinsured motorist coverage. You should protect yourself and your family to the same degree that you protect a stranger. To do anything less is to gamble that every person who hits you will be a responsible driver with great insurance. And with 1 in 8 drivers on the road having no insurance at all, that is a terrible bet to make. In some states, these coverages are mandatory. In many others, they are optional, and you actually have to sign a waiver to reject them. Insurance companies might even present it as a way to save a few dollars a month. Do not fall for it. Rejecting UM/UIM coverage is like building a fortress with 3 strong walls and 1 wall made of cardboard, hoping the enemy only attacks from the front. The threat is real, it's unpredictable, and it comes from every direction. So we've done it. We've built the core of a truly protective, truly full coverage policy. We have liability to protect us from ourselves, collision and comprehensive to protect our asset, and now uninsured/underinsured motorist coverage to protect us from the ghosts and zombies on the road. This is the holy trinity, the bedrock of financial security behind the wheel. But our fortress isn't quite finished. There are a few smaller, but incredibly powerful support systems we can add. These are the low-cost options that handle the infuriating, inconvenient, and often overlooked costs of an accident. They are the final touches that turn a good policy into a great one, and they can save you from a world of headaches. What are these final essential pieces of the puzzle? Let's put the finishing nails in the coffin of confusion. First, let's talk about the unsung hero of any good policy: rental reimbursement. Imagine this. You're in a not-at-fault accident. The other driver's insurance is taking their sweet time, dragging their feet on accepting liability. Meanwhile, your car is in the shop for 2, maybe 3 weeks. How do you get to work? How do you take your kids to school? You're forced to rent a car out of pocket, shelling out $50, $60, even $100 a day. That's over $1,000 you didn't budget for, all because of someone else's mistake. Rental reimbursement coverage solves this. For a few extra dollars a month, often less than the price of a single fancy coffee, your own insurance company will pay for your rental car up to a certain daily limit and for a certain number of days, usually 30. It gives you immediate mobility and removes the stress of waiting for another company to do the right thing. You get back on the road, and you let your insurance company fight the battle to get that money back from the at-fault party. It is one of the cheapest, highest value coverages you can possibly add. Next up is its close cousin, towing and labor, or what many people call roadside assistance. We've all been there. The dead battery in a dark parking lot, the flat tire on the side of a busy highway, the horrifying realization that you locked your keys in the car. These aren't accidents, but they can ruin your day and drain your wallet. A single tow can cost hundreds of dollars. An emergency locksmith call isn't cheap either. Roadside assistance coverage is your get-out-of-jail-free card for these situations. For a tiny addition to your premium, you get access to towing, battery jump starts, flat tire changes, fuel delivery, and lockout services. It's not just about the money, it's about the peace of mind. It's knowing that with one phone call, help is on the way, and the bill is already taken care of. Now for a big one, a piece of the puzzle that is absolutely non-negotiable for millions of drivers: gap insurance. The term GAP stands for Guaranteed Asset Protection, and it does exactly what it sounds like. It covers the gap between what you owe on your car loan and what the car is actually worth at the time it's declared a total loss. Let's paint a picture. You buy a brand new car for $35,000. You put a little money down and finance the rest. The second you drive it off the lot, it depreciates. It loses value. A year later, you still owe $30,000 on your loan, but because of depreciation, the car's actual cash value, what the insurance company will pay you, is only $24,000. Then disaster strikes. Your car is stolen and never recovered, or totaled in a crash. The insurance company writes you a check for $24,000, but you still owe the bank $30,000. That means you have to write a check for $6,000 for a car you no longer have. You are literally paying for a ghost. This is what we call being upside down on your loan, and it's a financial nightmare. Gap insurance pays that $6,000 difference. It makes you whole with the bank so you can walk away clean, without a mountain of debt for a pile of scrap metal. If you are leasing a car or if you financed a new vehicle with a small down payment, you don't just want gap insurance, you need it. Closely related but different is new car replacement coverage. This is a premium option, but it's powerful. Let's use the same scenario. Your one-year-old car is totaled. Instead of just giving you the actual cash value of $24,000, new car replacement coverage will pay to replace it with a brand new car of the same make and model. It completely ignores depreciation. It's a way of saying, I don't want to deal with the financial hit of my new car losing value if something bad happens early on. It's typically only available for the first couple of years of a car's life, but for those who want ultimate protection on a new purchase, it's a fantastic option. And in our modern world, we have to talk about rideshare coverage. If you drive for Uber, Lyft, or any food delivery service, this is critical. Your standard personal auto policy explicitly excludes commercial activity. That means the second you turn on that app and are waiting for a ride request, you are likely uninsured by your personal policy. The rideshare company's insurance has its own phases and coverage gaps, especially in that period where you're available for a ride, but haven't accepted one yet. Rideshare coverage is an endorsement you add to your personal policy that fills these dangerous gaps. It ensures you're protected from the moment you log in to the moment you log out. Driving for a rideshare service without this endorsement is like walking a tightrope without a net. So, after this entire journey, what have we learned? The most important lesson is this: full coverage is a myth. It's a marketing term, a convenient shorthand. It is not a button you can press or a single product you can buy. Full coverage is a philosophy. It's a personalized bundle of individual coverages that you, the architect, designed to build a fortress of financial protection around your life. That fortress is built on a foundation of liability coverage, the part that's legally required and protects you from financial ruin if you hurt someone else. The walls are made of collision and comprehensive, the coverages that protect your actual car from damage, whether it's your fault or an act of God. The roof is your uninsured and underinsured motorist coverage, your shield against the millions of irresponsible drivers who don't have enough insurance, or any at all. The windows and doors are your medical payments or personal injury protection, ensuring your own medical bills are paid quickly, regardless of fault. And finally, the security system, the finishing touches, are those endorsements we just discussed: rental reimbursement, roadside assistance, and gap insurance. The right combination is different for everyone. If you drive a 20-year-old beater worth $800, paying for collision coverage might not make sense. But if you have a $60,000 loan on a new truck, skipping collision and gap would be financial insanity. Your policy needs to reflect your reality. So what do you do now? I want you to take action right now. First, find your current auto insurance policy. Look for the declarations page. It's the summary of everything you're paying for. Pause this video if you have to. Go get it. Second, with that page in hand, audit your coverage. Look at the numbers. Are your liability limits really high enough to protect your house and your savings? Do you have uninsured motorist coverage? Is the deductible on your collision coverage so high that you couldn't actually afford to pay it tomorrow if you had to? Be brutally honest with yourself. Third, assess your life. Did you just buy a new car? You might need gap. Do you have a long commute? Rental reimbursement is probably a good idea. Do you have an amazing health insurance plan? Maybe you can have lower medical payments coverage. Do you have a massive emergency fund? You could consider raising your deductibles to lower your premium. Your insurance should evolve as your life evolves. And fourth, once you know what you need, shop around. I cannot stress this enough. The number one mistake people make with insurance is staying with the same company for a decade out of blind loyalty. That loyalty is almost never rewarded. Every insurance company has a different secret recipe for calculating rates. One company might penalize you for your zip code, while another might give you a huge discount for your perfect driving record. The only way to know if you're getting a fair price is to compare. Get at least 3 to 5 quotes, and consider talking to an independent insurance agent. Unlike a captive agent who only works for one company, an independent agent works with dozens. They work for you, not the insurance carrier. Their job is to take your specific needs and find the company that offers the best coverage for the best price. In the end, this isn't just about buying a piece of paper. It's about buying certainty in an uncertain world. It's about transferring the risk of a $100,000 catastrophe from your family's finances to a multi-billion-dollar company that is built to handle it. You are paying a small, predictable fee, your premium, to protect yourself from a large, unpredictable, and potentially life-altering loss. You've made it through this entire guide. You are now more knowledgeable about auto insurance than 99% of the drivers on the road. You are no longer a passive buyer. You are the informed architect of your own financial security. If this series armed you with the knowledge to protect yourself and your family, then do us one small favor and hit that subscribe button. Our entire mission here is to decode the complex financial world and give you the tools that institutions and big companies don't always want you to have. And you'll want to be here for our next video. We are pulling back the curtain on a question we get constantly. How do insurance adjusters actually calculate the value of your totaled car? We'll expose the tactics, the data sources, and the negotiation strategies you need to know to make sure you get every penny you're owed. Hit that notification bell so you don't miss it. Finally, look at the policy you just pulled out. Based on what you've learned, leave a comment below telling us the one coverage you're going to add or increase. Let's build a community of smart consumers and learn from each other's decisions. Drive safe and be well.